Hi everyone, today we'll be going over accounts October-November 2021, paper 2-1, question number 1. This is structured paper 2, which consists questions of 90 marks, and it also has a time limit of 90 minutes. And since question number 1 is of 30 marks, we will be attempting to solve this question under 30 minutes. So without any delay, let's get started. Eleni owns a business selling computers. She does not maintain full accounting records. And we're given the information at 30 June 2021 and 1st July 2020. So this column gives the information for the opening date. So these all are the opening balances. And this column gives the information at 30 June 2021, which is the ending date, meaning that these are the closing balances. Alright, then we're also given a summary of receipts and payments made through the bank for the year ended 30 June 2021. We're given receipts and payments. And we're also given the information that all cash sales are banked. Now let's have a look at the first question. We need to calculate the total revenue for the year ended 30 June 2021. So this kind of question was already done for the May June series for the year 2021. Let's repeat the same process. So we will start with the closing trade receivables value. This is because trade receivables always relate to credit sales, right? And the closing trade receivables indicate the amount that is yet to be received for the sales or the credit sales made during the year. So we need to include this amount. Then we will subtract the opening trade receivables. So the opening trade receivables, we will deduct this value because this is the closing trade receivables for previous year, indicating that these are the amount yet to be received in turn of the credit sales made in the previous year, not the current year. That's why we will be subtracting this amount. Then we will add the cash sales. And these are the cash sales made during this current year. And we will also add the credit sales. Alright, now totaling these four amounts will give us the total revenue for this current year. Now first let's find out the figures for closing and opening trade receivables, which is given in this table. Right here we're given the trade receivables. So the closing balance is 5,650 and the opening balance is 7,200. Let's write that down. The closing balance was 5,650 and the opening was 7,200. We will be subtracting the opening trade receivables. Now we need to add the cash sales, and we were given the information that all cash sales are banked, which means that we need to look at the receipt section, and it is given right here. Cash sales banked amounts to 3,980. Let's write it down. And this credit sales indicates the amounts received in terms of credit sales. So whatever credit sales made during the year, the amount received in turn of it is the credit sales. So this is also given in the receipt section right here, receipts from credit customers, because they took the goods on credit. And it amounts to 58,960. So we will just substitute this amount. So the amount for credit sales is 58,960. Now in order to figure out the total revenue, we need to add these four figures. So that's going to be 5,650 minus 7,200 plus 3,980 plus 58,960, which gives the total revenue to be 61,390. This concludes the first part. Let's move to the second one. We are given additional information of the cash withdrawn from the bank. So let's first have a look at the payment section. We are given right here that the cash withdrawn amounted to 14,080. So out of these amount of 14,080, Eleni took 450 each month. So this is a monthly drawing. We need to calculate the annual drawings and pay total wages of 7,620 for the year. The remaining cash from the cash till was used to pay for general expenses. Now we need to prepare the cash account to calculate the amount paid in cash for general expenses. So firstly, whenever we're talking about any kinds of account, we need to figure out the opening balance. So we need to figure out the opening cash balance. Let's have a look. So we're given cash in hand right here, and we have the opening value of 150. And there is no closing value. Again, given in the additional information section, whatever closing balance was remained, those were used to pay for general expenses, right? So there is no closing balance here. Now, the opening balance is always recorded on the debit side for cash account. So let's do that. You can write it under the heading of balance BD, which indicates the balance brought down. That's going to be 150. Now, let's have a look at the receipts and payment section. We are given that the cash was withdrawn amounting to 14,080. So obviously when we withdraw cash, cash comes into the business. So it increases the amount of cash holdings. So whenever there is an increment in the cash account, it is recorded on the debit side. So let's record it under the heading of withdrawn. This amounts to 14,080. Now, out of the cash withdrawn from the bank, Eleni took 450 each month for drawings. So drawings obviously reduces the amount in the cash account, which means that the reduction is always recorded on the credit side. So this drawing will also be recorded on the credit side. Let's do that. But remember that the drawings given here is relating to each month, but we need to figure out the annual drawing. In order to do so, we just multiply the monthly drawings by 12. This gives the annual drawing to be 5,400. Nextly, we also paid for the wages amounting to 7,620. Obviously, this also reduces the balance in the cash account, so this must be recorded on the credit side. Let's do that. So wages, it amounted to 7,620. And then the remaining cash were used to pay for general expenses. So obviously, general expenses is also reducing the balance in the cash account, which means that it will be recorded on the credit side. Let's do that. Here the value for the general expenses is going to be the balancing figure. So we need to figure it out. In order to do so, we first figure out the total for the debit side. That's going to be 150 plus 14,080, which amounts to 14,230. So this must be true for the credit side as well. Now, in order to figure out the balancing figure, we just subtract all of these values from the total amount. So that's going to be 14,230 minus 5,400 minus 7,620, which amounts to 1,210. So this concludes the second part. Let's move on to the third one. We are again given additional information. Eleni wishes to write off an irrecoverable debt of 50 at 30 June 2021. Alright, and she wishes to maintain the provision for doubtful debts at the same percentage as the previous year. So we do not know the percentage for the previous year's provision for doubtful debts. Let's just figure that out first. So we're given the amount of provision for doubtful debts right here for the opening values, and we're also given the trade receivables right here. So we need to figure out the percentage. So how much of the trade receivables is the provision for doubtful debts? In order to do so, we just divide the provision for doubtful debts by the total trade receivables and multiply it with 100, because we need to figure out the percentage. So this gives the provision percentage to be 5%. This means that we also maintain the closing provision at 5%. Let's just figure out the closing provision as well. I'll write it right here. Closing provision for doubtful debts. Alright, so we have the trade receivables of 5,650. And closing provision is always maintained at the end of the year. But we know that there was an irrecoverable debt of 50 in the month of June. So we need to deduct that amount as well. Now we'll multiply it with the provision rate, which is 5%. You can write it down as 0.05. This gives us the closing provision for doubtful debts value to be 280. So right here, the value is going to be 280. We can see that the value for the provision for doubtful debts is decreasing, and this decrease is always recorded as an income in the income statement. All right, let's have a look at another information. Equipment sold during the year had a valuation of 140. Let's have a look at the equipment sold. So it is given right here, the sale of equipment. For the sale of equipment, we received an amount of 180. So this is the sales value. But it had the valuation of 140, meaning that the net book value was 140. Obviously, we received a greater amount than the net book value, which means that there is profit on disposal. Let's just figure out the profit as well. This is going to be the difference between sales value and net book value, which is 180 minus 140, which gives the profit on disposal to be 40. Again, this will also be recorded in the income section in the income statement. Now let's have a look at the question. We need to prepare the income statement for the year ended 30 June 2021. All right, so we will be starting with the total revenue. And we figured the value for the revenue in the first part. Let's have a look there. It was 61,390. Let's substitute this amount. Now we will subtract the cost of goods sold. So the first one is always going to be the opening inventory. Then we need to add purchases. Then we need to subtract the closing inventory. Now let's look for the amount for these three headings and also look for if there are any other items that should be recorded under the heading of cost of goods sold. All right, so inventory is given right here. So the closing inventory amounted to 1,940, whereas the opening inventory amounted to 2,210. Let's substitute these two values first. So we had the opening inventory of 2,210 and the closing inventory of 1,940. All right, let's look for the value of purchase. So we are not given any heading stating purchases, which means that in order to figure out the amount for a purchase, we need to repeat the same process as we did in the first part in order to figure out the total revenue. All right, so in order to figure out the revenue, we subtracted the opening trade receivables from the closing trade receivables and added the cash sales and credit sales. Now we will repeat the same process for purchases, meaning that we will start with the closing trade payables. Then we will subtract the opening trade payables. Then we will add the purchases of the year. So this purchases indicates the payments made to suppliers, which is given right here. All right, and this will give us the value for total purchases. So we already have the payments to suppliers amounting to 39,750. Let's look for trade payables. So trade payables is given right here. And the closing value had the amount of 2,120 and the opening had the value of 1,440. Let's write that down. So closing value was 2,120 and the opening value was 1,440. Now in order to figure out the total purchases, we need to add these three amounts. So that's going to be 2,120 minus 1,440 plus 39,750, which gives the total purchases to be 40,430. Now we will substitute this amount into our income statement. So the purchases is of 40,430. Let's have a look to see if there are any other items that should be included in the cost of goods sold section. Alright, it includes only those three items relating to the opening inventory, closing inventory, and purchases. Now we can figure out the total for the cost of goods sold. So in order to do so, we need to add these three items. So that's going to be 2,210 plus 40,430 minus 1,940, resulting in the cost of goods sold to be 40,700. Now we will subtract this amount from the revenue in order to figure out the gross profit. So that's 61,390 minus 40,700, which results in gross profit to be 20,690. All right, now we will add any other sources of income. So there are basically two incomes. One is the decrease in provision for doubtful debts. And the other one was profit in disposal of equipment. All right, let's look for the values of these two items. The opening provision for doubtful debts was 360 and the closing provision for doubtful debts was 280. So the difference is just going to be 360 minus 280, which is 80. So this will be the amount to be substituted in the decrease in provision for doubtful debts. Now let's look for the profit. We already figured out the profit on disposal to be 40. So let's substitute these two values. So decrease in provision for doubtful debts had the value of 80 and profit in disposal had the value of 40. So this gives the total other income to be 80 plus 40, which is 120. All right, now we'll subtract the overheads. Let's look for the overheads. All right, right here we have the overhead wages. Let's have a look at the above information to see if we need any adjustments. All right, we can see that there is an adjustment to be made for rent and there is an adjustment to be made in the wages. So the payables for wages at the closing date is 110. This is the amount that we need to pay in return for the wages for this particular year, meaning that this amount of 110 should be recorded in the income statement. So we need to add the value of 110. Then we have the opening other payables with the amount 190. So this is the amount for wages yet to be paid for previous year. But since we're talking about income statement, we only record the expenses relating to this particular year, meaning that this expense of 190 should not be recorded. So we need to subtract this amount and add this amount. All right, but we also know that the cash paid for the wages during the year amounted to 7,620. So this amount should also be included in the income statement. Let's write these amounts down. So we have wages. Firstly, the cash paid in return for the wages was 7,620. Then the closing payables for wages was 110. We need to add it. And the opening payables for wages was 190. We need to subtract it. This gives the total wages to be 7,540. Okay, let's look for another overhead. Again, we have general expenses right here. So this is the amount that we need to include in the income statement. That's 1,210. Let's look at the above information to see if there is general expenses as well. So it is given right here, meaning that this amount of 940 should also be included. So there were no adjustments. The adjustment were only relating to rent and wages. So we need to add these two amounts in order to figure out the total general expenses for this year. Let's do that. All right, so the cash paid for general expenses was 1,210, and we also made the payment of 940 for general expenses. So this gives us the total general expenses for the year to be 2,150. Okay, let's look for another overhead. So we have rent right here. This is the amount 6,860. We should record this in the income statement, but we also know that there is adjustment to be made for rent. So this is relating to prepaid. All right, so the closing prepaid balance was 1,080. So this means that we paid 1,080 for the next year. And since we're talking about income statement, we only record the expenses for this particular year, meaning that this 1,080 should not be included. So we need to subtract this amount. Then we have the opening rent prepaid of 500. So opening rent prepaid was the rent prepaid for this particular year. So this is essentially an expense for this particular year, meaning that we need to include this amount. So we will add this. All right, let's write these three amounts for the rent. So that is rent. The amount paid was 6,860. Then the closing prepaid amount was 1,080. We need to subtract it. And the opening prepaid amount was 500. We need to add this. So this gives the total rent for this particular year to be 6,280. Okay, let's look for another overhead. Okay, one is right here. There was an irrecoverable debt. And irrecoverable debt is obviously an expense, so let's record it. So that's irrecoverable debt of 50. Okay, let's have a look for other information. We have equipment, so obviously there must be depreciation on equipment as well. We already have the closing value of equipment, opening value of equipment. We know the sales made in the equipment had the net book value of 140. Let's look if there were any addition to the equipment. So there is purchase of equipment. All right, now we will make a schedule for equipment. I'll write the format down first. So we always start with the opening value. And this is always the net book value. Then we will add any new addition to the equipment. So new addition are always recorded at cost. Then we subtract any disposal of equipment. So disposed value, we always record it as net book value. Then we subtract the depreciation for the year. And this gives us the closing value. So closing value is the net book value. Now I'm going to substitute the amounts for these 5 headings and write it in the form of an equation. Let's first have a look at the opening value. So the opening value of equipment was 3,460. Let's write that. Then there was purchase of equipment amounting to 610. So we need to add this amount. There were disposal, and the disposed equipment had the net book value of 140. So we need to subtract 140. Then we need to subtract the depreciation charge for the year. This is the heading that we are trying to figure out. Then this gives us the closing value, which is already given in the information. It amounted to 3,250. Let's write it down. So we can just move the depreciation to the other side in order to figure out its value. So that's just going to be depreciation equals to 3,460 plus 610 minus 140 minus 3,250, which gives the depreciation charge of 680. Let's write it down in our income statement. So this is the depreciation on equipment, and it amounts to 680. Okay, let's move back to information again. So right here we are given the bank charges. This is also an overhead, so we need to record this in our income statement. Let's do that. So bank charges amounted to 50. Okay, let's have a look at the information again. So we had the opening bank loan of 1,350, but there is no closing bank loan, meaning that we repaid this bank loan, right? So let's have a look at the payments. We're given that the bank loan repayments amounted to 1,390, but the bank loan that we took only amounted to 1,350, right? Which is given right here. So this means that the additional expense that we paid in the heading for bank loan repayments, those can be amounted as the interest on the bank loan. So let's figure out the interest. So this is just the difference between the repayments and the actual bank loan. So that's 1,390 minus 1,350, which gives the interest to be 40. So interest charge should also be recorded in our income statement. Let's do that. So we can write it down as bank interest, and this amounted to 40. Okay, let's have one last look. I think we included everything. So we included this as well, bank loan repayments. This was also included. And for these information, we included the provision for doubtful debts. We included this as well. We included the bank loan as well. So we clearly included everything in our income statement. So we can just figure out the total for the overheads and then proceed towards figuring out the profit for the year. First, let's figure out the total for overheads. So in order to do so, we need to add these amounts. So that's 7,540 plus 2,150 plus 6,280 plus 50 plus 680 plus 50 plus 40, which gives the total overheads to be 16,790. And these need to be subtracted in order to figure out the profit for the year. All right, we will start from the gross profit. To the gross profit, we will add other income and then subtract the overheads. So that's going to be 20,690 plus 120 minus 16,790, which gives the profit for the year to be 4,020. This concludes the third part. Let's move on to the fourth one. Okay, so we are given workings right here. So whatever I did the calculations on the question paper, it's better to do in the working section. Make sure you guys do that and not scribble all over your question papers. Okay, now we need to prepare an extract from the statement of financial position at 30 June 2021 to show the capital and liability section only. Okay, let's start with the capital section first. So for capital section, we start with the opening balance of the capital. And then we add the profit for the year. And then we subtract the drawings. Okay, let's first substitute the values for profit and drawings. So profit for the year was 4,020. Let's write that down. And we calculated the drawings in the cash account, which we did in the second part. So drawings is given right here as 5,400. Let's substitute this value again. So that's 5,400. Now for the opening balance of capital, capital is not mentioned anywhere in the given information. So we need to figure it out by ourselves. And how do we do so? So we already know that this column gives the values for the opening date, meaning that we can figure out the opening balance for capital from this column as well. So we know the equation that asset equals to capital plus liabilities. So we need to figure out the capital. In order to do so, let's just figure out the total value of the assets from this column first. So equipment is definitely an asset. Inventory is also an asset. Trade receivable is also an asset. Provision for doubtful debts should be subtracted from the trade receivables. So that's a negative that should be included in the assets. Then other receivables, that is again an asset. Trade payables is a liability. Other payables is also a liability. So bank is given in credit section. So this means that this is actually a bank overdraft, which is recorded in the liabilities section. Then cash in hand, that's an asset, and a bank loan. So that's a liability as well. Now let's just figure out the total for the assets. So that's 3,460 plus 2,210 plus 7,200 minus 360, because we need to subtract the provision for doubtful debts from the trade receivables, plus 500 plus 150. So that gives the total for the assets to be 13,160. Let's write that down. Now we need to figure out the capital, plus let's figure out the total for liabilities as well. So that's going to be 1,440 plus 190 plus 860 plus 1,350, which gives the total liability to be 3,840. Let's write that down as well. So from this, we can easily figure out the capital. That's just going to be 13,160 minus 3,840, which gives the opening balance for the capital to be 9,320. So we just substitute this value in our statement of financial position. So that's 9,320. Now let's figure out the total for the capital. That's just going to be 9,320 plus 4,020 minus 5,400, which gives the total capital to be 7,940. All right, now let's move to the liability section. So we do not have any non-current liability because there was only one non-current liability of bank loan, but we already repaid that. So there are no more non-current liabilities. We only have the current liabilities. Let's look for that. All right, so the first one is trade payables. It has the value 2,120. Then the second one is other payables for the wages. This amounts to 110. And again, we have bank in the credit section. So this means that this is actually a bank overdraft, and bank overdraft amounts to 1,420. So these three are the liabilities that we need to record in our statement of financial position. Let's do that. So firstly, we had trade payables. And trade payables amounted to 2,120. Then we had other payables for the wages, and this amounted to 110. And lastly, we had bank overdraft, and this amounted to 1,420. So this concludes the liabilities section. Now we need to figure out the total for liabilities. So that's just the sum of these three amounts. So that's 2,120 plus 110 plus 1,420, which gives the total for liabilities to be 3,650. Now we can figure out the total capital and liabilities. So this is just the sum of the capital and liabilities. So that's 7,940 plus 3,650, which gives total capital and liabilities to be 11,590. All right, this concludes the fourth part. Let's move on to the fifth one. So we're given additional information that Eleni is concerned that she is not earning enough profit, so she is considering increasing her prices by 5%. We need to advise Eleni whether or not she should increase her prices by 5%. Alright, the first point is that increased prices results in a higher profit if the demand is maintained. So we can write it down. Increased prices results in a higher profit, but only if the demand is maintained. Nextly, increased prices may lead to a possible loss of customers because they might think that the prices are higher and they might want to buy the products from a competitor who might give those products at a cheaper rate. So increased prices may lead to a possible loss of customers. Alright, nextly, increased prices might lead to some customers perceiving the goods as of higher and better quality because people tend to associate goods of higher prices with that of better quality. Let's write that down as well. Increased prices might lead to some customers perceiving the goods to be of higher and better quality. Okay, and lastly, prices should be determined by considering the competitors' prices as well, because we cannot be unreasonably high with our prices as compared to other competitors. If we do so, then there is definitely a loss of customers. Let's write it down as well. Prices should be determined by considering the competitors' prices. Okay, based on these points, now we have to make a decision. I would make a decision to advise Eleni to increase her prices by 5% because she is only earning a profit of 4,020, which is pretty low. It might be low compared to her competitors as well. We wouldn't know because we would require her competitors' information as well in order to figure that out. But personally, I would recommend Eleni to increase her prices by 5%. So let's write it down. Eleni should increase her prices by 5%. This concludes the fifth part. Let's move to the sixth one. We need to state 3 factors that a business should consider when making a provision for doubtful debts. So the first one obviously is the amount of trade receivables, because as we did in the question, we figured out the provision for doubtful debts to be a certain percentage of the total trade receivables. So obviously the amount of trade receivables is crucial. Let's write it down. So that's amount of trade receivables. Okay, second one could be past experiences. So you need to have past experiences with your credit customers to know whether they might pay promptly or they might delay their payments and result in a possible irrecoverable debts. So let's write it down as well. Past experiences. Lastly, we also need to know the state of the economy, because if the countries or the particular place's economy is going down, then there is a possible chance that your credit customers might not be able to return the sales amount. So let's write it down as well. State of the economy. Okay, this brings us to the end of the sixth part as well as the end of this question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed and hit the bell icon so that you do not miss any of these videos in the future. Thank you.